I'm Karen McBride, Executive Editor of the Westchester County Business Journal, talking today with Anthony Domino Jr. Anthony is president of Associated Benefit Consultants in Rybrook, and we're going to be talking today about the stock market, which is on everyone's radar.
This most recent volatility is the result of what's being called a liquidity crunch. So the concern is not as much that I need my money out, it's that I'm afraid I won't be able to get my money out. And that is a very dangerous problem, really, to have inside a market. That's pretty much exactly what created the great market crash in the 1929 that led to the Great Depression. But the bottom line is that the run on the bank, everyone wanting all their money at once, is always dangerous. And that's what is the potential, I don't think you're anywhere near it now, but the potential, logical, ultimate conclusion to people being afraid that in this case, the credit crunch and people won't be able to borrow money. And this is driven from people being concerned that they won't be able to get a mortgage the way they could have gotten it 2 weeks ago. Here in Westchester, for that matter, any of the three areas that the Business Journal serves, it's very interesting. The uncertainty is probably the greatest impact. I would have to say, certainly we have clients and employees of clients who are counting on getting a mortgage or a subprime mortgage. Their credit wasn't good enough to get a full mortgage, or a traditional mortgage, so they would go to the subprime market. Some of them may have been aggressively financing their homes. So a traditional mortgage is usually provided on 80% of the value of the piece of property that you're buying. What had become in vogue was 90, 95, 100, maybe even 110% of the value of the property was being lent on. That's okay in an increasing market, but that real estate market, but that's not good in a decreasing or stagnant real estate market. So many of these employees are concerned about what's happening. Some of these business owners are concerned to the extent to which it affects their own financing. We've seen some real estate developers have credit crunches with the regular payments that they make to their investors. I actually invest in a specific real estate limited partnership that sent a letter instead of a distribution. This quarter I got a letter, and the letter said, because of the recent credit crunches, we count on quick short-term borrowing to pay all of you the dividends. We couldn't get that money. Rest assured that the underlying project remains stable and strong, is what this developer said. I have to believe him at his face value. But you'll see that we'll make this up in return as that credit crunch eases. So what he is doing is taking a steady hand approach to the problems and keeping a level head about him and not overreacting to what is a real business problem for him. So I'd say that most business owners, it doesn't affect them that directly, but it certainly affects the environment that they're operating in. And if it starts to affect their ability to carry out their business or trade with their customers and clients, then it's problematic. But almost like maybe food poisoning, if you let this thing go through your system, if you don't need to pull out of the market and liquidate, then in all probability the time is to hang in there. And you will not need to worry about, if you don't have the need for liquidity, then the markets can do what they do, and hopefully you have a long-range horizon, and you should be able to weather that storm. And that food poisoning will pass, you'll be fine, you'll deal with it in the long run. If people overreact and overrespond, it can spiral into a much worse situation. Because the credit crunch problems are real. I'm not poo-pooing what's happening. The underlying facts of the situation are real. It's the reaction. Okay? It's not the splash, it's the ripple. The splash is the credit problems. The ripple is how all of us feel about it. We were talking before about a run on the bank back in the Great Depression. I mean, that run on the bank creates a problem for everyone who wants their money. So you don't want to be the last one in line. You want to be the first one in line. You're going to cut off that little old lady in line too if you can. So that's what you want to avoid, is hysteria or overreaction or over response to whatever that stimulus is. The stimulus is real. These banks that made these subprime loans, these bad loans, are really, and this is what the government needs to work out, the regulatory bodies as well as the central bank. How do they want to respond? Do they want to let these companies that made these bad decisions sit in it and face the financial consequences of it? Most of us would answer yes, as long as it doesn't come back and affect me.
Right.
So those banks that made bad decisions, they have to respond in the marketplace of capitalism and fair economy back and forth and survival of the fittest, and some of them may, some of them may not.
Anthony Domino Jr., President of Associated Benefit Consultants in Rybrook. Anthony is also a contributor to the Business Journals, so we'll be checking in with him in a couple of weeks to see what's going on with our money. I'm Karen McBride, Executive Editor of the Westchester County Business Journal. For more on all your local business news, check out this week's edition of the Westchester County Business Journal. And of course, you can see us online at www.westchestercbj.com. Thanks for tuning in.